Hi, in this session I will take you through why there is a need for accounting standards and what are various boards which are prescribing accounting standards and what are various accounting standards available and what is the background while issuing the accounting standards. Why we need accounting standards is to have common set of procedures, principles that are prescribed so that all similar entities will follow similar kind of procedures so that the end users, whoever it is, either it may be banks, statutory authorities, or internal users or external users like shareholders, will have some understanding about the procedures that will be followed by the entities. So that is the reason it is required to have common set of procedures and principles. Now coming to what are various boards available who are prescribing the accounting standards. You can say accounting standard board, which is constituted by Institute of Chartered Accountants of India and National Financial Reporting Authority. This is constituted under Companies Act. Whenever Ministry of Corporate Affairs wants to prescribe accounting standards that has to be followed by companies, they will do in consultation with NFRA, and globally there is one body called International Accounting Standard Board, and this was earlier called International Accounting Standard Committee. This Accounting Standard Committee, International Accounting Standard Committee, was in existence till 2001. Then it is reconstituted as International Accounting Standard Board. Coming to various standards which are prescribed by these boards, accounting standards, these are prescribed by, these are issued by Accounting Standard Board, that is Institute of Chartered Accountants of India, and these standards are prescribed to all the entities and these are also prescribed to companies, but when it comes to companies, it will be prescribed by MCA in consultation with NFRA. And coming to international accounting standards, these are prescribed by International Accounting Standard Committee, which was in existence till 2001. After that, International Accounting Standard Board started issuing the accounting standards that are known as International Financial Reporting Standards. This is famously known as International Financial Reporting Standards. However, even after reconstitution into International Accounting Standard Board, they have not withdrawn any accounting standards issued by International Accounting Standards Committee. What they have done is they have either made some improvement to it or they have issued new standards wherever it is required, but they have retained International Accounting Standards as well. Coming to what exactly the accounting standards does. See, usually what will happen, there should be generally accepted accounting principles that are spelled out by these boards. Okay, in case of India, their generally accepted accounting principles are prescribed by Institute of Chartered Accountants of India, or there are other bodies also. And in case of globally, if you see, IFRS is many countries are following IFRS reporting. So these are accepted accounting principles are prescribed by International Accounting Standard Board as well. Why these generally accepted accounting principles are required is to have, as we discussed, common set of accounting procedures and principles. Okay. Now, what is the aspects which are covered by accounting standards? That is recognition of events and transactions. That is which kind of transactions have to be recognized or which kind of events have to be recognized, and what are the measurement procedures to be followed while recognizing these particular events or transactions. Okay, then how they have to be presented in the financials, and same way how they have to be disclosed. Okay, so just presentation, not how they have to be disclosed, what are the various formats which has to be given so that it will be easy to the end users to ever use the financial statements. And coming to what are the benefits of accounting standards, which we have been discussing, standardization of alternative accounting treatments. See, what will happen is when there is one kind of business, like say for example, inventory valuation, okay, then accounting for leases. There are various methods which are available. So in order to eliminate all the differences between various methods and who has to follow, which entity has to follow what kind of method, it will help in standardizing these procedures, okay. And requirement for additional disclosure. Suppose there is no requirement by statute, there is no requirement by any statute to disclose, but still if these boards feel that there is additional requirement of disclosures, then they will prescribe that the accounting standards, while disclosing the financial statements, there is some additional disclosures also that will give more information to the end users. And comparability of financial statements. So when I am trying to compare the performance of two similar entities, it will be easy for me if the procedures and principles are standardized. It is easy. Otherwise, it will be not easy to compare, or I have to do further working. Even if they have followed two different, suppose somebody has followed FIFO, somebody has followed weighted average, then still I know, because they will disclose that they have taken closing stock on FIFO basis or weighted average basis something, then I will work backward and I will be able to arrive. At least that much information will be there, and what are the procedures, if that is disclosed, then accordingly we can do the comparison. So accounting standard will help in comparing the financial statements of different entities. And coming to how these accounting standards which are issued by Institute of Chartered Accountants of India, what is the process they follow is identification of area. So they will say there may be industry bodies, ASSOCHAM, CII, all this may come up with, there may be some requirement to have common one kind of disclosure, or institute may think that there should be some kind of there is a requirement that any particular area requires that standard has to be issued. So they will first identify the area where the standard is required, then they will constitute a study group. Various study groups will be constituted with people who has got good knowledge in those particular area, and preparation of draft candidate circulation. So they will prepare, these groups will prepare the draft standard, and it will be circulated to various bodies like ASSOCHAM, even RBI, then RBI, and also other statutory bodies also, okay. Then ascertainment of views of different bodies, that is, you say for example SEBI, CBDT, okay, they will circulate all this draft to publicly also, and also to various bodies, so that they will give their views and their ideas. Then finalization of exposure draft. So they will finalize after getting all their views and having discussions with them. They will finalize this particular draft, and they will see comments issued on exposure draft. They will review and modification of the draft. If they feel it is required to modify accordingly, then they will modify the draft and they will issue the accounting standard. As of now, if you see, Institute has issued 32 accounting standards. However, they have withdrawn 30, 31 and 32, and accounting standard 6 and also accounting standard 8, because they were getting duplicated in some other accounting standard, and hence they have withdrawn those accounting standards. So as of today, if you see, there are only 27 accounting standards which are prescribed by Institute of Chartered Accountants of India. These are with respect to accounting standards. Coming to IFRS, that is International Financial Reporting Standards. Why there is a need for IFRS is because Indians are doing business in foreign countries, even foreign country individuals and corporates are investing in India. So there is a need for global reporting requirement. Okay, so we should, like India has got its own economic environment, other countries have got their own economic environment, so their rules, regulations are different. However, when they are people from foreign countries are investing, either it may be institutional investors, FDI, whatever it is, then they expect some kind of reporting. That is the reason when the globalization, liberalization is happened, then there is the need for global reporting standards are came into requirement. Okay, so that is the reason this international financial reporting standards have to be followed even by Indian entities wherever it is applicable. It is not applicable for everybody. They have given a roadmap how it has to be, how which entity is required to follow IFRS. Then accordingly, those entities have to report their numbers under IFRS as well, so that the users of this financial statements who are outside India also will be able to understand the procedure what they have followed and the numbers, and that confidence they get on their investment as well. Okay, if you see how it is, IFRS standards are issued. IFRS issued by IASB, that is International Accounting Standard Board, which we have discussed already, and IAS issued by IASC and adopted by IASB. So what they are saying is, I told you earlier also, this whatever accounting standards which were issued by International Accounting Standard Committee till 2001, they have been adopted by International Accounting Standard Board also. Okay, and international interpretation of International Accounting Standard issued by International Committee. Okay, so whatever interpretation has been given, that is also taken part in the IFRS standards. Okay, now interpretations of Indian International Accounting Standards and International Financial Reporting Standards issued by IFRS Interpretation Committee. Okay, so whatever interpretations also they have made part of this IFRS standards, that is what they are trying to tell. Now coming to what are benefits of IFRS, which we have already discussed. This is cross-border flow of money, listing of companies at global stock exchange, because if we are if you see, even Indians are procuring many entities outside India, so then those entities are getting listed in foreign stock exchanges. So that time we have to report the numbers as per their prescribed formats. That is the reason this IFRS has to be followed. And comparability of financial statements and low risk of error. So when they are trying to invest in India, or Indians are trying to Indians are trying to acquire entities outside India, and there are investors of foreign countries, then they will be cautious, they will understand the financials, because they are investing money, and the risk of error will be less, and helps investors in decision making also, and great transparency. Okay, these are the advantages of international financial reporting standards. Coming to IND AS. See, now first we have discussed accounting standards, next we have discussed what is IFRS, and now coming to IND AS. See what India has done, rather taking IFRS standards as it is to India, they have not adopted as it is. They have made some changes depending upon the economic environment of Indian conditions. Okay, see, maybe there may be certain assumptions which have been made while preparing the IFRS, then it is not applicable to India. So if I go as it is blindly with applying IFRS, then there may be chances that my reporting will be not as expected. Okay, that is the reason what India has done is they converged the IFRS standards into IND AS, Indian Accounting Standards. Okay, so that is what I am trying to explain here. ISI, convergence of IFRS, not adoption. That means they try to take the applicability of IFRS to India wherever it is matching the economic conditions of India. Okay, where it is not matching, where the assumptions of IFRS are not as per Indian standards, then they try to converge that particular aspects and they modified accordingly. So it is not adoption, it is a convergence. Okay. So application of IFRS in India considering legal and other conditions prevailing in India. So what they have done, wherever there is a deviation from corresponding IFRS is required, then they have made those changes. Okay. And they have still maintained, India has still maintained two standards, that is Indian Accounting Standards IND AS and existing accounting standards which are issued by Institute of Chartered Accountants of India. So this is called convergence of IFRS to IND AS. Okay. If you see how IND AS are named, if you see the numbering of IND AS, they have just added 100 to IFRS number. Suppose if IFRS accounting standard number is 1, they made it IND AS accounting standard 101. So every accounting standard of IFRS they have added 100 to just correlate the numbering process for IND AS. Okay. Now IND AS accounting standard, in what way it is helpful is globalization and liberalization. So it helps in having same set of procedures, principles in the accounting, and transparency of financial statements. Same, these are nothing but the advantages of implementing IFRS, and comparability of financial statements, enhanced disclosure requirement. These are common, whichever standard you take, whether within India or within globally, these are common benefits of having accounting standards, whether it is IFRS or other accounting standards. Coming to concept of carve-outs and carve-ins. See, while convergence, at the time of convergence, they tried to explain which are carve-outs and which are carve-ins. Okay, so suppose if IFRS has given options to follow the procedures, say if they have given 3-4 options to follow the procedures, then India has taken whichever is applicable to India. In that case, it is not carve-out, because IFRS says you can follow procedure A, B, C, and while doing IND AS standard, India what it has done is it has taken any one of the procedures which is applicable to India. Then it is not called carve-out. Okay, it is just taken as it is from IFRS. Okay, what is carve-out is, if suppose they have given some procedure which has to be followed, but which is that particular procedure is not applicable to India, then they have removed that procedure and they have given new procedure. In that case only it is called carve-out. Okay, and what is carve-in? Carve-in means there may be some additional disclosures, or there may be additional requirements that has to be followed as per the, which is not there in IFRS, but it is required for Indian conditions, then that is called carve-ins. Okay, like say terminology changes. So terminology changes, if you see in IFRS, they say different profit and loss account, they say statement of revenue. For balance sheet they use another term. Okay, so those terms have been removed, and we maintained balance sheet and statement of profit and loss account. Okay, so then that is not called as carve-outs. It is changing as per the Indian conditions. And removal of options. I said removal of options also is not carve-out. It is they have given certain options, but we have taken whichever option is required, which is applicable to India. And economic, so wherever there is economic environment of the country that are presumed in IFRS, see, there may be certain assumptions while making the standards. There will be certain assumptions which are not applicable to India, and then we cannot follow that. Then that is called carve-out. So every change is not a carve-out. That I wanted to highlight here. There may be certain changes which are not carve-outs and certain changes which are carve-outs. Okay, that we have to see depending upon the. This is theoretical part. It has no implication on standard, just for understanding purposes. Okay. Hope you have got broad view of the accounting standards, IND AS and IFRS. Thank you.